That year, crypto took off, Bitcoin. And we were the first public asset manager to give our clients exposure to Bitcoin through GBTC, which was a grantor trust at the time. And Bitcoin in 2017 went from less than $1,000 to $20,000 by the end of the year. But we believe that the return on invested capital in the United States, because of the deregulation and tax changes, return on invested capital in the United States is going to increase relative to that in the rest of the world. That's dollar positive. That is dollar positive. So I think that's why the markets are powering forward in the U.S.
Hey guys, welcome to Everyday Finance. The CEO of Ark Invest, Cathie Wood, makes it clear that Bitcoin will continue to rule the cryptocurrency market and outperform its rivals. Ark's analysis of Bitcoin's performance throughout several market cycles comes to the conclusion that every correction merely strengthens the cryptocurrency. The change is evident at every level. Big businesses are incorporating Bitcoin into their balance sheets. Governments with shaky currencies are investigating it as a reserve asset. And institutional investors are expanding their exposure through ETFs. Its position as the most reliable and robust digital asset, which no cryptocurrency can yet match, is cemented by its increasing popularity. What highlights that the defining strength of Bitcoin is its fixed supply of 21 million coins. In contrast to altcoins that inflate through fresh issuances or fiat currencies that suffer from endless money printing, Bitcoin's inherent scarcity promotes long-term value growth. This scarcity effect, along with its growing worldwide network, puts Bitcoin in a position to eventually beat more established stores of value like gold and even stocks. In summary, Cathie Wood believes that Bitcoin will not only weather future cycles, but will also continue to grow in strength, value, and popularity, guaranteeing its position as the leading cryptocurrency for many years to come.
What's interesting, when we started the firm, one of the reasons I started the firm is because we were seeing traditional asset management go benchmark or passive. And I said, wait a minute, there is so much innovation about to explode. The seeds were planted during the early part of my career in the 1980s through the tech and telecom bubble. They were planted then. Now they're flourishing. And so I said at the beginning, we want to own innovation. So thank you for saying that. What's interesting about that story is AllianceBernstein got the first exemptive relief to start a fully active equity ETF, the first one and so I said, I'll do that. And then, when others in the organization got involved, it became quite controversial. So, it was good for me. I didn't realize how good it would be over the long term that we agreed to disagree, and I was able to go on my merry way. I always felt we would be onto something, but a couple of things. 2017 was critical, I think. So we started in 14. 2017 was when we broke even and then hit our hockey stick. That year, crypto took off, Bitcoin. And we were the first public asset manager to give our clients exposure to Bitcoin through GBTC, which was a grantor trust at the time. And Bitcoin in 2017 went from less than $1,000 to $20,000 by the end of the year. And so that many people had in 2015, when we first put it in the portfolio, dismissed it as a marketing gimmick. Many in the ETF space, because we had just started, oh, right, marketing gimmick. But it wasn't. In fact, the more I heard that, I said, oh my goodness, nobody really understands how big this is going to become. Yes, and we're listening to the markets as well. This market, the stock market, is climbing the proverbial wall of worry. And it is broadening out. In fact, that concentration towards the Mag 6 is starting to broaden out. That's a very strong bull market. Now, why is this happening? Yes, the headlines blare negative news, as you say. It seems to get a lot more attention. If you look under the covers, at least in the United States, there are some provocative changes taking place in terms of deregulation. I don't think people understand how much deregulation is taking place in the U.S. In every industry, and then the one big beautiful bill, OB3, we've nicknamed it OB3. Underneath those covers are tax cuts that I don't think many people, even in the United States, understand, because they're mostly focused on the corporate sector, and they're allowing full expensing of structures, equipment, domestic R&D, and software in year one, first year of service. That is taking the effective tax rate in the United States from 21%, where it is today. This is effective. It'll still be there.
This is corporate tax rates.
This is corporate tax rates, 21% down to 10. So it's in the 10 to 12% range. Some of the lowest in the world. And so you hear a lot of people saying, okay, American exceptionalism is dead. The dollar's demise is upon us. And first half of the year, biggest decline in the dollar since 1973. That was all true. But we believe that the return on invested capital in the United States, because of the deregulation and tax changes, return on invested capital in the United States is going to increase relative to that in the rest of the world. That's dollar positive. That is dollar positive. So I think that's why the markets are powering forward in the U.S. Do care about valuations, and many people think we don't, but it is a part of our discipline, and I'll get to that in a moment. I think many investors in the United States are very focused on the short term, and the short term means they want their profits now, their dividends now, their share repurchases now. Companies very focused on innovation are actually sacrificing short-term profitability in order to capitalize on these massive opportunities. That's what we do. So if you're asking me that question, yes, I think there's too much focus on the very short term. Our investment time horizon is 5 years. And when it comes to valuation, we make the assumption that whatever premium to the market our portfolios are valued at now, that premium to the market is going to compress towards a market multiple within 5 years. So we are looking at valuation as a headwind for us in the next 5 years. And our analysts have to believe that the revenue growth and margin expansion in the portfolios and associated with each stock are going to be strong enough to overwhelm the valuation compression and deliver our investors a minimum hurdle rate of return of 15% at a compound annual rate.
Mm-hmm. 3 main factors set Bitcoin distinct from all other digital assets, according to Cathie Wood. She begins by outlining how Bitcoin operates as a worldwide monetary system based on complete scarcity. With a limited quantity of just 21 million coins, it represents sound money in a digital format that is impervious to manipulation and inflation. Second, she highlights the unparalleled technological dependability of Bitcoin. No other network of its size can match its Layer 1 blockchain's 10-plus years of safe operation without ever being compromised. Because of this, Bitcoin is the most reliable and safe platform for storing and exchanging value on a worldwide scale. Thirdly, Wood points out that Bitcoin has developed into an entirely new class of assets. Its position in the global financial landscape has been solidified by the respect it has received from institutional investors, regulatory bodies, and even national reserves. Wood believes that Bitcoin will continue to be the biggest, most powerful DeFi ecosystem, and the expansion of Layer 2 networks like Coinbase's Base and Robinhood's impending chain.
Sure. We are not, in the top 10 of our portfolios, you will not find the Mag 6 for the most part. They might earn their way if they do very well in this new age. And the reason is we're focused on the purer plays. There are a lot of high expectations for this new world in the Mag 6. And we're hearing already Apple, a lot of controversy around its AI expertise. We have been worried about that for 6 to 7 years because we've watched Apple, which should have moved into the ultimate mobile device. What is that? Robotaxis. And they tried. And they had one management turnover after another. Robotaxis, we believe, are the largest AI project in the world. And Apple, by all rights, should have been there, given its focus on hardware, on mobility. But they couldn't get it right because it's an AI project. And I don't think they were able to hire the right kind of expertise. Or, from another point of view, even now, they have put their AI strategy under the former head of Vision Pro, which wasn't really a big success. This should be coming from Tim Cook, the highest levels. And so they haven't done that yet. Apple, we have been concerned about their AI expertise. All of the others, they have been extremely successful, right? So they're at the top of these indices, all of the broad-based indices. And that means historically they've had a lot of success. Our focus is on truly disruptive, technologically enabled innovation. And so if we're right on that, there's always the possibility that past successes, which created duopolies, almost monopolies, are going to create problems for them. Now, we were actually very surprised at how quickly Google is reinventing itself. It always had the best AI researchers in the world. It bought the UK's own DeepMind, right? And now it is starting to get with the program. We're quite impressed at, they're in the full stack of AI, from chips, TPUs, to the cloud, GCP, to large language models, Gemini. And so we're very interested in what they're doing, I have to say. Amazon agentic AI is going to challenge it to some extent, because this idea that we start our shopping experience at Amazon may not hold true as much in the future, but they'll probably be like the Walmart of retail in the future. Meta platforms, we thought, oh my gosh, they're doing such interesting things. This open source strategy in AI and large language models was working, and then it didn't work. It wasn't keeping up with even Grok XAIs. So we're wondering what's going on there. We think it's going to be winner take most, and we're already seeing victims. So this acqui-hire strategy that especially Meta Platforms has now, Mark Zuckerberg is plucking talent, usually the CEOs, out of companies, LLM companies that are probably not going to make it. So we're already seeing that a number of companies are giving way to the big four, which would include Gemini as well. So yes, we do think, and the amount, and if you look at what's happening as they're leapfrogging one another, OpenAI has stayed really ahead, but to watch Grok or XAI in terms of the large language, to see it shoot up ahead of OpenAI in February, OpenAI then leapfrog, but to see that happen so quickly, even before Anthropic and Meta, Llama, was very interesting. So this is the big race, and it is winner take most. They can develop expertise in different kinds of LLMs. So Anthropic was coding. Now OpenAI wants more of that market. I think XAI is going to be a very interesting one to watch because this is key. What is going to be the defining factor in who wins almost anything in AI? It's proprietary data. And when you think about XAI, you think about all of Elon's companies and all of the disparate data that nobody has. So the Tesla data, Neuralink, AI is patterned after the brain. Neuralink getting a lot of information there. SpaceX getting data that nobody else has about space. And even Boring Company, tunneling. So these are disparate forms of data. Everybody thinks it has to be just text and the internet. No. There's pattern recognition. This is all about pattern recognition.
Ark Invest is not pursuing thousands of cryptocurrencies, as Cathie Wood has stated. Only a select few, in her opinion, have genuine long-term promise. And Ark's public portfolios demonstrate this narrow belief. Bitcoin, which she views as the foundation of a new international monetary system, is at the top of her list. She thinks it will continue to be the biggest and most significant cryptocurrency by a significant margin because of its fixed supply of 21 million coins, which makes it the epitome of digital scarcity. Ethereum comes next, which she believes is crucial to the decentralized finance space. The foundation of DeFi is Ether, which enables the smart contracts and decentralized apps that take the place of conventional middlemen. Through Bitcoin immersion products, Ark just obtained regulator-approved exposure to Ethereum, enabling the company to profit from its growth while adhering to regulations. Additionally, Wood notes that significant activity on Ethereum is being driven by the emergence of Layer 2 networks, like as Coinbase's Base and Robinhood's impending chain. She acknowledges that there is some ambiguity regarding the ultimate distribution of wealth between these scaling layers and Ethereum's main chain, but she nevertheless sees Ethereum as essential to the larger cryptocurrency ecosystem. Wood claims that Solana, the third significant holding, has developed into a significant participant. Once a hazardous experiment, Solana has developed into a high-performance blockchain that can compete at scale thanks to its speed, efficiency, and increasing institutional adoption, which includes backing from the UAE Hyperliad, to Solana in its early stages, calling it exciting and worth seeing. In addition to these primary resources, Ark carefully investigates services and infrastructure related to cryptocurrency markets, such Uniswap and decentralized exchange and money market-style items within the Solana ecosystem. Wood emphasizes, however, that these are low-level roles. According to her, Bitcoin, Ethereum, and Solana form the three solid pillars around which the digital asset ecosystem is built. In contrast to these pillars, which she believes will shape the future financial system, she claims that all else is speculative noise.